28th, 2026. And we are on a virtual teleconference for this meeting. And the first item is the minutes of February 10th, 2026 special meeting. If I could have a motion by a member.
Move to approve.
Thank you. Peace,
Second.
Dave. And second, motion by Councilmember Curtis, second by Councilmember Savigny. And is there any discussion of motion? Any corrections or additions? All right, members, all those in favor, if you'll say aye and give me your hand.
Aye.
Aye.
Is anyone opposed? All right, that motion passes. And we have our third quarter expenses, FYI. You can see the budget, the detailed expenses, and we'll lump, well, I guess we'll do the letters separately. Are there any questions about the third quarter expenses? It is just for your information. It's fairly straightforward. All right, seeing none, could I have a motion to approve the letter of transfer?
Move to approve.
Thank
Second.
you, Councilmember Savigny, second by Councilmember Curtis. Now, are there any questions about the transfer letter? It's also fairly straightforward. All right, seeing none, all those in favor, please say aye and give me your hand. Aye.
Aye.
Is anyone opposed? All right, that motion passes. Now we want to welcome David Calvert, and where did I see you, Allison? Allison Corbley are here. Yes, welcome. And I'm not sure who's going to start this out. Is that you, David, or is that you, Allison?
It will be me. Yes.
Okay. All right. Very good. Welcome.
And I should be able to share my screen. And everyone should be hopefully seeing a full screen of the presentation, which you also received an electronic copy yesterday. Thank you, Samantha. So just as a snapshot, as of March 31st, 2026, the overall pension fund had a market value of $40,578,188. If you compare that to December 31st, 2025, specifically looking at the return-seeking portfolio, it did decline slightly, more specifically by about $570,740. And you will notice that during the course of the first 4 months, it has been definitely a roller coaster ride. If you recall, February 28th is when the United States and Israel attacked Iran. This resulted in a market sell-off going through the end of March. And since then, things have increased in value, specifically if you look at a point in time for the return-seeking portfolio as of today, it would be worth $37,600,000, or an increase of $2,067,000. So this report is already stale, but it is reflective of March 31st valuations.
And that's close to a 6% return. That's how strong the correction's been.
Yeah, specifically, it's like the S&P 500 was up 9.9% just for the month, and the NASDAQ is up 15.3% month to date, just through yesterday's close. So the overall allocation is a continuation of the themes we've talked about. The return-seeking portfolio is a 60-40% allocation, meaning 60% in equities, more specifically 40% in domestic equities and 20.5% in international equities. And then there's a allocation to fixed income securities, 39.3%, plus when you add in the cash equivalents of 0.2, you're at 39.5%. We talked about this last quarter. No updates because the actuary report comes out once a year, but the plan is overfunded. It's a rare instance about pension plans throughout the country. Some performance snapshots. So the return-seeking portfolio, as I mentioned, declined slightly in market value. That was a decline of 1.58%. Meanwhile, the benchmark return was 1.66% to the negative. So we outperformed the benchmark by 0.08% for the 3-month period ending March 31st, 2026. The liability defeasing portfolio, because of the higher absolute levels on fixed income securities, it actually had a positive change in market value, an increase of $26,101, or a return of 52 basis points. One small change that we had during the first quarter, and that was in February, we adopted a slight tactical overweight to U.S. small cap equities with the addition of a ETF, specifically the iShares Russell's 2000 ETF, and underweight the fixed income allocation. That's why you're seeing that 60.5 versus 39.5% allocation. Over the last 12 months, the return-seeking portfolio increased in market value by $4.1 million, had a total return of 13.1%. The liability defeasing portfolio had a return of 4.45%, which resulted in a combined return of close to 4%. Here are the historical performance numbers. We had a relatively good relative performance, but we are still trailing the benchmarks for the prior periods. That's going to take some time in order to recoup those periods of underperformance in previous years. From a market update perspective, as I mentioned, starting on February 28th, geopolitical risks have basically overtaken the market, and we continue to have a lot of volatility based upon the latest news coming out of the Middle East. The Federal Reserve during the first quarter paused, and they kept rates unchanged, leaving them at 3.5 to 3.75. They are going to meet again tomorrow. It is widely expected that they're going to leave rates unchanged. And then one new outcome that just happened last week is that the Department of Justice decided to cease its criminal probe of Chairperson Jerome Powell. This paves the way for the Senate Banking Committee in order to basically push along the nomination of Chairperson of Kevin Warsh as chairperson. And then on the yield curve and market volatility, we've seen considerable market volatility, not only in the equity markets, but also the fixed income markets. There is great concern that the higher oil prices is going to result in essentially inflation remaining a lot stickier, and there's not going to be as much room for the Federal Reserve to cut rates earlier in 2026. So diving into some of these themes, as we are paying close attention, oil prices are much, much higher than they were just 2 months ago. And many other commodity prices, such as natural gas, ammonia, urea, polyethylene, are all up significantly since February 27th. This is definitely going to result in higher prices in the future, while other concerns is fertilizer that comes from the Middle East, and that the impact on agricultural products because of higher prices there. With these higher prices, the Federal Reserve is expected to still remain on hold as it sort of assesses the evolving risks related to the economy. But forward inflation expectations are significantly higher than they were just 2 months ago. One of the most notable things, as you just kind of drive to and from work, is gasoline prices. All across the country, you are seeing gasoline prices up significantly since February 28th. Looks like Kentucky has some of the highest increase year over year. I think that's partly because you have lower gas prices. So when you're comparing percentage increases, In Pennsylvania, where I'm located, we have some of the highest state gasoline state taxes. So our prices are generally higher than the rest of the country to begin with. So percentages are more muted. Economists are not as concerned as they were like in prior kind of supply shocks with oil because of the chart on the right-hand side. Gasoline and other fuel spending is a smaller percentage of overall household spending than it was in the 70s or even in the 90s, for example. As you can see here on the chart on the right-hand side, gasoline and other fuel spending is accounting for about just 2% of overall household spending. So even if there is a shock of upwards of 50% in gasoline prices, it's not going to have as much of an impact on disposable income as it used to do in 40, 50 years ago. However, I think it's still going to be quite painful for a lot of the population with these higher prices. So from an inflation perspective, we already saw a significant increase. The March report, which is not reflected on this chart, increased significantly. It was up to 3.3% for the year-over-year increase in March. I believe that's the right number, compared to 2.4%. Meanwhile, the unemployment rate has been basically holding in that low 4% range. It was 4.3% in March. One of the concerns and what is being closely observed by the markets is the number of new jobs being created. The pace of new jobs has been slower than, let's say, about 2 years ago. Instead of seeing consistent numbers in the 150,000 range, we're seeing numbers more in the 75,000 range from a rolling 3-month basis. And a lot of people are saying that this lower number is satisfactory for the economy because of the significant change in immigration policy that we have seen starting in 2025. From an economic perspective, we've also seen some volatility in 2025. It's like economic growth in the first quarter of the year actually contracted by 0.6%. This was because a lot of retailers were front loading inventories. During the second quarter, as things sort of unwound with the announcement of tariffs, we saw GDP growth increasing by 3.8% and 4.4% during the second and third quarter. But then things have slowed down once again during the fourth quarter, increasing at a rate of 0.5%. When you average those four numbers together, you get GDP growth of 2.03%. And looking ahead, we're kind of seeing similar growth in that low 2% range. This isn't bad growth, but it's also not very strong growth either. So it's definitely in that middling of the pack where it's like I think a lot of folks would hope to see better growth rates. However, it is not a concern as of yet for an impending recession. Over the next 4 weeks, I think one of the biggest things that the markets are going to look at is Fed policy. As I mentioned earlier, tomorrow there is a FOMC meeting. It is widely expected that Jerome Powell and the committee members are going to keep the federal funds target rate unchanged at 3.5 to 3.75. But the story behind that is what is going to happen over the course of the next 4 weeks on whether or not the Senate is going to basically confirm Kevin Warsh as the next Federal Reserve chairperson, and what does he bring to the table. I think many, as we've talked about previously, many view Kevin Warsh as going to want to maintain the independence of the Federal Reserve. However, he might be a little bit more dovish or more inclined to lower rates than Jerome Powell. As things transpire, I think we're going to get a better picture. And in general, the equity markets as well as the fixed income markets, if we have a Federal Reserve chairperson that is going to be more accommodative and lower rates, this generally means the markets are going to do a little bit better than expected. Now I'm going to turn it over to Allison.
Sure. Thank you. Good morning, everyone. Can you hear me? Yes? No? Okay, perfect. Okay. Dave did a great job articulating a lot of the factors in the economy that the committee is considering or monitoring over the next 6 to 12 months in our positioning there. I'm going to focus on primarily the bottom two rows here, and then use some charts to illustrate our backing behind this. We have seen financial conditions, and really this is a result of the conflict in the Middle East and tightening financial conditions, and we can continue to monitor those events. If you recall, last year at this time, we were going through the tariff crisis, and the first quarter of 2025 turned into negative territory, but yet closing out 2025 in positive territory. So the comment here is this short term, or is this going to be long term in long in the tooth in us getting a resolution in the Middle East? So financial conditions, we've moved to the neutral territory due to the geopolitical conflict, and as well as you have additional inflationary pressures and higher energy prices. Corporate fundamentals, though, continue to be strong, and I'll illustrate that or share that in a chart in the following pages as we see companies continuing to meet or beat expectations. From a valuation standpoint, the correction in the first quarter really helped to temper those valuations and bring them back into historical averages. And then on the far right, the political concerns, we were back into the red, and this is really primarily due to the conflict in the Middle East and the ongoing geopolitical uncertainty as a result of that. So let me share a couple of charts. If you turn to the next page, Dave, please, and indicate to you what we're looking at from a valuation standpoint. Valuations are as one characteristic or factor our investment committee considers and in investing in equities. On this chart, we're illustrating the broad base of the equity marketplace. The far right represents the Russell 3000. That's really encompasses your entire U.S. equity marketplace. The Russell 1000 would be just the component of large cap. S&P 600, represents small cap arena, and the chart or the bars on the far right-hand side, EFA is your developed international equity marketplace, and the far right, emerging markets, for the EM is your emerging market space. The navy blue line indicates your 5-year average. Ultimately, when you're looking at opportunities, you would consider PEs that are lower range, a lower price, stock price versus their earnings potential. We did see in 2025 that dislocation of very high prices, trajectory going north, and what the question was, could their earnings keep up with the momentum of those stock prices? We did see a correction in March with valuations coming into more respectable measures, particularly in the U.S. equity marketplace. As you can see on that navy blue diamond, valuations or earnings valuations are lower than their 5-year minimums or averages. If we move to the next slide, so what does this mean for earnings going forward and the U.S. equity marketplace? Well, if we were to take this chart and update it through mid-April, those light blue lines would actually be higher. So what we're seeing is that earnings expectations have steadily revised upward, reflecting confidence in corporate fundamentals. And, we do continue to monitor the volatility, but corporations now, different than past environments, really still have strong balance sheets, low debt to equity ratios, and we are seeing a repeat performance of 2025 where companies continue to beat their expectations. Now, one would logically ask what sectors are driving this? And, honestly, it really will be in the financial and the tech sectors are really driving these returns for the calendar years moving forward. Looking at the international equity markets, we did mention that there was the correction Dave mentioned in March. We moved into 2026 very similar to how we were in 2025, with a very resilient marketplace. And we saw the non-US equity markets really benefiting from that weak US dollar. And that continued into 2026, or the first really 2 months of 2026, where the non-US equity markets were generating great returns. The far left-hand side of this chart shows you the average weight of developed international equity markets in the EFI index. And you can see on the far right, the month-to-date contribution to return. That light blue, or the darker light blue line, represents that local currency return. And then when you translate that into US dollars, you can see in March, the strength of the US dollar impacted non-US equity returns, thus closing the non-US equity marketplace in negative territory, as well as the US equity marketplace. So how we position the portfolio, as we look at slide 20, last quarter, we were in the more neutral. If you recall, we moved from defensive early part of 2025 to neutral the close of 2025. We started out 2026, and again, a really stable environment, inflation coming down, better footing from a fundamental standpoint. And the investment committee made the decision to overweight small cap based upon attractive fundamentals, and trimming down the fixed income component of the portfolio to pay for that slight overweight in small cap, which we currently still have in the portfolio. I'm going to ask just the next page, and we did talk about the markets already for the quarterly market summary. Dave indicated that the return for the risk-seeking portfolio was negative. A lot of that had to do with the exposure to equities in the portfolio. Again, it started out as being a very resilient quarter, really changed course due to the conflict. And really, it was March that took us out of the strong positive territory into the negative territory. As Dave alluded to, inflationary concerns, waning consumer sentiment. Will the Fed cut this year? And now it's probably not until 2027. So it really led to meaningful volatility across all asset classes, quarter to date, year to date. If we were to put on the month of April, you would see a complete reversal. As again, Dave indicated, the portfolio is up about 6% just because of that correction in the market. So if we move to the performance portfolio, because I know that's very important for us to address, and it is a concern for the committee, on page 29 of the packet, it's difficult to regain returns when you're lagging the market, and particularly, more importantly, if you're really lagging the benchmark. So we were able to protect the portfolio from some of the downturn in the market. That was a result of March. Particularly what helped this portfolio was our exposure to international equity. Some of your active managers outperforming for the quarter. You do have a good percentage weight, though, to passive in the portfolio for the international exposure as well. We do have work to do. We know Dave and I both understand and recognize, we are a co-fiduciary with this board, and we are committed to returning this portfolio to above benchmark returns. Floyd Simpson, who is one of the investment committee members now leading our research, has made some changes on the active manager front. And you can see that in some of the investments that we have in the portfolio that we have added in December. One of them would be an active small cap manager Osterweiss in the portfolio, as well as last year we added PIMCO as a small cap active manager. And we are retooling some of the non-international equity exposures in the portfolio. We did add 2 emerging market active managers, Pazina as well as Driehaus. Let me also indicate these aren't significant weights in the portfolio for equities. Primarily, your heavier weight will be in the developed non-US equity market for your international equity exposure. And then in the US, it would be your large cap, would be your primary exposure in the US equity marketplace, using these sub-asset classes as opportunities to add value. Any questions from the committee before I go to the next page for the fixed income?
Are there any questions? Anybody? Okay.
Okay, and on page 30, our fixed income portfolio, we do continue to outperform on the fixed income portfolio. Again, that's that opportunity of being well diversified. Corporate exposure really does support the portfolio and garnering a bit of a higher yield in return for the portfolio, primarily staying more active in this area versus being married to a benchmark that's primarily committed to treasuries. On page 31, let's take those percentages and put them into absolute dollar returns. Yes, it was negative for, through March. So your return on investment was in the negative range, but let's flip it and look at to the full year. Your return on investment is over 4 million for the portfolio, really a result of those strong equity markets. Going forward into 2026, our team continues to see more opportunity to add value in the equity space and maintaining your 60-40% exposure. As Dave already shared with you, as of the close of last night, the portfolio is up to 37.6 million. Again, that's just that correction on the equity markets themselves. On page 32, we're staying in line with your target allocation. Slightly, we're in line, maybe slightly overweight to the asset classes. We haven't made any additional investment changes quarter to date for this month. The only changes has been made, and we continue to stay long in, is that small cap in the portfolio. And then for page 34, how much are you paying approximate fees for the underlying managers that we have? It's roughly about 50 basis points for the portfolio for these managers, for the sub-advised funds that we have in the portfolio. Any questions?
Does anyone have questions? I don't see any right now.
No?
Thank you.
Okay, thank you so much. Well, I'll pass it back to Dave.
Sure.
Any?
Just the remaining portion of the report just covers the liability defeasing portfolio. There's no significant changes as we've talked about before. This is structured in order to meet all the actuary expectations for benefit payments, and it's doing exactly what it was designed to do, and just humming along fine. One thing that I thought I would kind of just bring up, it's like we've had a structure of 60, 40, 6% equity exposure, 40% fixed income exposure. I think over the last 12 to 24 months, there's been a lot more clarity on how this pension fund might transition over. And would it be useful if we kind of revisit the overall asset allocation and determine from the board whether or not a different asset allocation might be appropriate? Let's say a higher exposure to equities, for example. And we're not going to have this entire discussion on this call, but it's like we could come back, and that's generally a 30 to 45-minute discussion.
Okay, so you would bring back some possible recommendations or thoughts.
So what we would do is we would run a model portfolio on your current asset allocation, looking at the projected risk return profile for intermediate would be 7 years out, as well as a long-term forecast. Again, these are projections. So we do the capital markets assumption models, a proprietary and also Monte Carlo simulation we incorporate, and we prepare them at year end. So we have them updated through the end of 2025, looking into 2026. So it'll show, based upon that asset allocation, the projected return along with the associated risk. And then, as Dave mentioned, we would also include other asset allocations. And then it will give us the opportunity, and the committee the opportunity, in over, a look at what you currently have in that projection. And then if we retooled or we tweak the portfolio into maybe a 70-30 allocation, maybe including some liquid, diversified real assets in the portfolio. Again, staying all liquid, what does that profile look like, intermediate and long term? And this would also be a check and balance from a governance standpoint for your investment policy. And are you meeting the objectives of this portfolio, as you need to pay out to participants and their benefits? So and I think Dave is correct. It's about a 30-minute conversation discussion.
Okay, does that sound good to the members? Yes, I've got a
Thank you,
couple
Mike.
thumbs up.
And would that be more appropriate as like a separate meeting, or to include it on the agenda of one of these meetings? Because it's sort of more educational in nature as opposed to a decision-making process. So
Mhm. Did you say it would take about 30 minutes?
on the brief end, I would imagine that there might be some, it's definitely much more of a discussion. So
Mhm.
instead of it just being present, and we would hope to get some feedback on from the individual board members, because
Sure.
because over the life of our engagement, I think the priorities on what this pension fund is for has morphed slightly, not dramatically, but it has morphed. I think early on, it's like there was a lot of uncertainty on, it's like, okay, what would happen to these dollars once the last beneficiary is no longer part of the plan. So I think it would be nice to have a candid conversation on some of those priorities, and whether or not we just maybe mimic the overall asset allocation of your larger police and firefighters plan. That would be another route we could take as well, as opposed to thinking about this as a separate overall plan. So
Okay, well, I'm looking at Susan, our county clerk, Susan Lamb. I still have an intention, and it's probably about time to put together a small work group to talk about that particular piece. Right now, the whole pension would roll into the police and fire pension. We had some police who were interested in that conversation too, to maybe look at, how that might change a little bit. Um, but I guess I'd like to ask the board members, would you like to have a separate conversation on this overall asset and the look forward, or would you like it to be with a regular meeting? What's your pleasure? Our next regular meeting is July 28th. Oh, yes, Commissioner Hensley.
I think a separate conversation would probably be appropriate, Mayor. We did look at the investment allocation maybe about a year ago, and we did choose not to make any changes at that time. Not saying that we won't make any at this point, but I think past precedent did kind of carry the day. But I would also like to take a look, if you all can, at what it would have looked like if we were not actively managed over this period of time. How I don't know if you can do that. What would we have returned? What would it look like over this period of time? What were the alternatives? Because this is a different board, and it is, you know, a little bit more maintenance to some extent in some capacities. And so I just would be curious. One of my questions that I had was, you know, what have we paid in fees? And $183,000 is really not very much for what is being managed. So, you know, I'm actually pleased to see that. So, you know, that's not so bad. There are a lot of plans that are quite a bit more. So that I appreciate that. And I wasn't sure where to ask the question, but you all have mentioned when you include April, and I'm sorry, I'm just gonna throw them all in there now while I've got the mic for a minute. When you include April, we're returning 6%. Do you know what that is against the benchmark? What the benchmark is looking at with April?
I don't.
thought I'd
We can
ask.
get an estimate. Yeah. I'm hoping
thought
it's
I'd ask.
higher, of course.
Sure.
I don't have, I can get a preliminary number, but we've got a couple more days to the close. So
Fair enough.
I'm hoping to stay positive. With respect, Aaron, to that, typically, you know, the response would be if you were all passive, your return would be the benchmark return. It would be very difficult for us to go back and rebalance it against, you know, when we were overweight or underweight certain asset classes, because as a discretionary manager, that's one of our roles too, is to take overweights and underweights where they find opportunities and can benefit the portfolio. So but also, if you were to be all passive, again, those fees are much lower. I can add a more complicated response, or I can add a complicated component to the fee component. You're using our multi-manager sub-advised funds, which we sub-advise. The only fee Lexington pays us is for our advisory fee. So any of that sub-fund advisory cost, we give back to you, and it's credited on your invoice. If you look at the underlying manager fees that we're paying, which we showed in the presentation, I think it was like 50 basis points, that actually includes that sub-advised fee. So actually, your ultimate underlying manager fees are lower.
Okay.
So we are going into a whole new reporting system next year, or no, for the risk seeking will be by the last quarter of this year. We are going to be moving in time to showing a net fee return across, including our advisory fee. So you really get the complete transparent number, right?
Yeah, and I appreciate the answer about the benchmark. That was my assumption, but I didn't want to.
Sure. Yeah.
And
Yeah. Yep.
yeah, and just so you're aware, it's like even the underlying approaches such as ETFs or mutual funds that would use any passive approach, there would be small, like less than 10 basis points. In some cases, it's going to be less than 5 basis points. So you're just going to sort of always slightly underperform the benchmark because of the underlying ETF. Just so that you're aware that it's like it won't be spot on to the benchmark returns because of the underlying vehicle. Yes.
Okay.
And to Dave's point is that when we do have accounts that do passive in the equity and stay active in the fixed income, and I can tell you the underlying fee is about, for the managers, because it's more on the fixed income side, is about 20 basis points. Just looking at the equities, as Dave mentions, the average, if you just do all equity, is about 4 to 5. I mean, it's 3 basis points on our large cap that we use. So it's really, it can get competitive in various ETFs on the index side. And we really take a very focused, deliberate, a very focused approach and structured on the indices that we integrate into the portfolio. And one component really are the fees, because you're seeing even on the index side from various ETFs and different platforms, from Schwab to iShare to Fidelity, their fees are different across the board. So we do take a strong consideration, and when we review those managers we select for index, fee is a big component of that, along with the structure and how they replicate.
Thank you.
Okay, so Commissioner Hensley suggested us having a separate meeting to discuss the report that'll come forward. Other thoughts about that? Is everybody good with that? I'm seeing a lot of head shaking. And we can do it virtually, which makes it a little bit easier on everybody, I think, don't you? Are there other questions of Allison or David?
Mayor,
Yes.
I was gonna ask, would it be that we need to have that meeting prior to the July meeting? So if there's any decision-making to be taken into consideration, that during an actual meeting, we could make decisions and
That's,
take action?
yeah, great idea.
And I was thinking the same thing, that we might not be able to formally adopt any approach during that educational meeting, but then we could essentially make those as motions at the July meeting.
Mhm. And does that give you all enough time if we do it before the July meeting?
Oh, yes, yeah.
Yeah. Um, if everybody's good with that, I'll ask Samantha to maybe send a couple of dates around, if that works for everybody. See if we can get a quorum. That's one of our big challenges, isn't it, Samantha? Um,
But since
That's
it's an impromptu meeting, I'm not sure if a quorum is actually technically required, so,
well, I think anytime we meet, we're supposed to have a quorum,
okay.
even if we don't vote on anything. Isn't
Okay.
that right, Susan Lamb? I should ask Glenda. So it would, and I think it would be good to find a date when most of us could
Oh, yeah,
attend to hear
most
it.
definitely, yes. Yeah.
Mm-hmm. Yep. Okay, anything else? You know, I was thinking during this whole thing, who knew last summer that there'd be a war in Iran and all the gas would go wild and the market would go wild. So I'm interested in how you're going to do this, this model. The geopolitical part is really hard these days, isn't it?
It is.
Figuring it out. Yeah.
And one of the things that comes to light is it's very easy to miss a rebound day. So just a couple weeks ago, there was a significant concern from the president on what was going to be the status. And all of a sudden, we went from a much more expansive war to a ceasefire. And that one day alone, I think, shot the markets up about 2.5%. And you're just kind of waiting around at 9 p.m. There's nothing you could do at 9 p.m. And at the first trade that happens at 9:30, the markets are all up. So,
Well,
and
I've
there's
kind of
definitely,
decided to look at the news at the end of the week, the national news. Oh my gosh.
Yeah.
Okay. Is there anything else for the good of the whole? That takes us to the end of our agenda, and our next regular meeting is July the 28th. And then Samantha will take a look at the calendar and send out a couple dates. We'll do a little poll or something. Nothing else? We really appreciate David and Allison and your working us through all this. And I'll just ask if there's a motion to adjourn.
So moved.
All right. Is there a second?
Second.
All right. All those in favor? Aye.
Aye.
Thank you all. We are adjourned. Great to see
Thank
you
you.
all.